On this week's Emily Now episode, we're going to spend a little bit of time talking about alternative financing options for businesses. We're going to talk about how banks approve mortgages and loans in general. I'm going to give you an example of a business that took very expensive money and was able to work their way down to the most affordable money available in the marketplace. And we're going to talk a little bit about franchising, so stay tuned. My name is Dylan Gallagher, founder of mlenow.ca. Each week we put an Emily Now episode together to help you understand a little bit more about what's involved in borrowing money, either in a mortgage or a loan, for your business, for your home. We believe that if we're able to put this information in front of you, we can help you make better choices that ultimately helps you to do more. And with all of the money that you make from all of the great choices that you make, we believe that you'll probably use that money to save for the future, invest in new opportunities, or maybe contribute to the local community around you. So it's really important to us that we try to take our 18 years of experience and knowledge and give it to you, and we do it in the form of these Emily Now episodes. I've been a finance guy for about 18 years, helping people and businesses with the money that they need, and our particular focus has always been in borrowing amounts of less than $10 million. So hopefully you find this episode helpful, and you can follow us on Twitter at Emily Now Canada. You can like us on Facebook. You can +1 us on Google. You can subscribe on YouTube. We're pretty much in most of the big social channels, and we certainly look forward to connecting with you there. So getting started with this week's episode, the first question that I'm going to answer is, what alternative financing options are available for private businesses? Now, I should tell you, there's actually lots of alternative financing that's available for private businesses, but I'm only going to focus on two today, and they tend to be, they're sort of in the same ballpark, so I thought it would be helpful to talk about both of them. So the first one is factoring, or accounts receivable financing. So this is an instance where, say you have you're a business and you've delivered a product or a service to your client, but they have 30, 60, 90 days to pay you, and you need the cash from that sale sooner than that. And so a company will come along and they'll say, well, no problem. If your invoice is $5,000, we'll give you $3,500 of it today, right now. And when the client actually pays the invoice, we'll deduct our interest, our fees, the $3,500 we gave you, and then we'll give you back the net proceeds. So that's called factoring, or accounts receivable financing. It's become hugely popular in the last couple of years. In fact, as I talk to businesses and factoring companies and try to understand where this market is going and what it's doing, it sounds to me like factoring and accounts receivable financing is sort of here to stay. We, in particular, we're in a province where there's large oil and gas companies that push a lot of business down to small oil and gas services companies. And part of the way the cash flow works is the large oil companies will take 60, 90, even longer potentially to pay an invoice, but these little companies, they've got to pay their field staff, they have to pay their office expenses, they have to pay for their equipment, so they need this cash flow. And if the bank's not going to give it to them, then they have to go somewhere else. And so accounts receivable financing, or factoring, or AR financing has become hugely popular, and I think it's here to stay. I don't think it's going away. I think because the companies have made it so easy to get the financing, you can be approved within 24, 48 hours. You can have a check shortly thereafter. Now, there's some criteria that you have to be able to meet, but generally speaking, very popular. Lots of businesses are taking advantage of it, and most businesses now are familiar with what it is, I would think, and if not, they probably will be shortly. The second type of financing that fits in the same sort of category is what's called POS financing, or point of sale financing. So you know those little credit and debit machines that you see sitting at the front register of a store. What a company will do is they'll look at the history of that credit or debit machine to see how much business actually goes through it, or how much cash, in essence, goes through that machine. And then what they'll do is they'll offer to finance a percentage of that cash flow. And basically what happens is every time that credit or debit machine is used, the funds go into an account, and then that money a percentage of that money gets redirected to pay off an amount of money that was lent to the owner of that business. So both of these type of financing really takes advantage of a future event. So if you're expecting cash, both of these types of financing solutions will let you get your hands on that cash today. Now, there's a cost to doing it, and there's some criteria such as, let's talk about the quality of your client. So in the example of factoring or accounts receivable financing, before a company gives you the check, they want to know, wait a minute, the person you're waiting to get paid from, are they bona fide? Are they a company we've heard of? Are they a company that we can believe will actually pay this invoice, or is it some company we've never heard of? If you're dealing with a lot of small companies that maybe no one has ever heard of, you might find it tough to get accounts receivable financing or to factor any of your invoices. If you have a POS machine, the due diligence is fairly light because the history speaks for itself. If your credit card and your debit card machine is generating a stable amount of receipts every day, every week, every month, then a company will feel pretty comfortable that they can lend you the money and expect reasonably to get it back. Some of the things that people don't know are factoring companies or POS companies. A lot of times you have to set up a bank account with that company, so that as your cash flow comes in from your POS machine, or as it comes in from clients, that the funds are being deposited into a bank account that company has access to, so they can take the money out, they can sign for it, they can get it back, and a lot of times this will be a condition of approval. The other thing that you need to know, and I don't know why this happens yet, but the interest rate is typically quoted in sort of 10-day cycles. So it's going to cost you X amount of dollars. It's going to cost you $3.23 for every 10 days that you have our money. Well, I've never found that math to be really helpful. I tend to think of things more on a month basis. What is the cost per month? Because then I can easily multiply it by 12 and say, well, then this is how much I'm paying per year. Because of the way interest rates are quoted, it can make it confusing to understand what your cost is, but basically you want to make sure that if you're going to take advantage of accounts receivable financing or point of sale system financing, that you actually do know what the cost is, because that cost comes directly out of your margin. And even though businesses will say, yeah, but I'm only borrowing the money for 10 days, or I'm only borrowing the money for 30 days or 60 days, that money still comes out of your profit margin. And so even though you're paying for it for 10 days, if you're paying for it every 10 days, over the course of a year, you've actually just taken a piece of your margin and given it away in interest. Usually there's an underlying reason why a business needs to factor an invoice or take advantage of POS financing. And so my advice always before we help anyone coming through mlenow.ca is, can you tell us maybe a little bit more about your business? Can you tell us if a major event has happened that has taken cash out of your business that you no longer have to keep it rolling? Or is this a new business, or has something transpired in the business where now sales have grown and you haven't caught up yet with your cash flow to be able to pay for it? So if we can understand what the reasons are for needing to take advantage of that financing, then we can make sure that we can help clients and we can direct them in the right way so that they do get what they need. Make sure that if you're going to take advantage of this kind of financing, that you do fix the underlying problem in your business. If you need true working capital, which is really kind of what this type of money is, then visit mlenow.ca, get your Emily score, and see which banks or lenders you may need to chat with. Accounts receivable financing or factoring, point of sale financing, these are tools to use, but you shouldn't be using them indefinitely because they do cut into your margin, and even though it's easy to use, there's always a cost for doing that. So there's a time and place to use that kind of financing, and then there's a time to wean yourself off of it and move across the street to something like a bank working capital line, where it really will help you bridge the difference between your receivables and your payables and is much, much more affordable. So make sure you have a plan to get your business to the point of where it's cash flowing. The second question I'm going to answer today is, generally speaking, how do banks approve mortgages and loans? Well, I've spent 18 years answering this question, and not only answering this question, but trying to put deals together for people that kind of follows this sort of pattern. And so there's sort of three areas that we talk about with clients. Certainly, if you went to mlenow.ca, you would see the same three areas reflected on the website. And so the first thing is just some answers to questions. Why do you need the money? How are you going to pay it back? Have you ever borrowed money before? So there's just some questions that banks are going to ask you. So they sort of start there. Then they move into asking for the documents that are needed to evidence the answers to your questions. So if you told us you made X amount of dollars on your paycheck, then we need to see a copy of your pay stub. If you tell us your business generates $1 million a year in income, we need to see financial statements to support that. So there's the questions that a bank's going to ask you, then there's the documents and the information that they're going to need to see to prove the answers out, and then there's going to be the numbers part of it, which is the math. They're going to run a bunch of calculations because now they've got the answers to your questions, they've got your documents, they can quickly determine, okay, is this person or does this loan application or mortgage application actually stand a chance of getting approved? Do they have enough cash? Do they have enough equity? Do they have enough income? Does their credit score give them access to the best interest rates? Does their company financial history, if they're a business, have enough good history to merit an approval? So it's not sophisticated what the banks go through, although it kind of feels like that when you're the one sitting on the other side of a table from a banker or a broker or a mortgage specialist or a loan specialist or a consultant or whoever you're using to help you get approved. But don't get lost in the forest. There really is sort of three big pieces that you need to know. You need to know what questions are you going to have answers to. You're going to have to be able to have the documents available to support the answers that you gave. And then at the end of that, you're also going to have to be able to prove out the math. And that's usually the part where most people get stuck. They can answer the questions, they can give someone all of their paperwork over a series of emails or faxes or physical paper, but where the average borrower tends to fall down a little bit is they don't know the math. They don't know the math feels like a black box. I just give my stuff to the bank and then I pray and hope that I get approved. Well, it doesn't have to be that hard. In fact, if you go to mlenow.ca, it's as simple as putting in a loan amount, and then you can see the math. That's all you got to do, just put in a loan amount. If you want $500,000, $500,000, next, you're going to end up seeing the income you need, the equity you need, the credit score you need. Of course, you'll see the questions and the documents, but the numbers part is where you want to focus on, and you want to make sure that your numbers check out, because banks don't have unlimited resources to be able to help you. What I mean is, every day there are people walking in and out of a bank, either in a physical branch or on the phone, and asking for money. But not everybody, they can't afford to spend time educating every single person that comes through their door. They can't afford to tell everybody, well, here's where your math is wrong, or here's the documents that you're missing. And so in order for you to get approved, you stand a higher probability of getting approved if you've kind of already done a lot of the preparation work. If you've already worked out the math, if you've already put your documents together and basically can give over to the bank a completed package. And so at mlenow.ca, that's why we built the platform. We believe that borrowing money isn't as difficult as the market leads people to believe it is. We think there are things that are more important than simply interest rate. You want to make sure that you are checking out the market and getting the best options that are available to you. So get the answers to questions, make sure you've got the documents, but most importantly, make sure that you know the math that the bank is going to look for and that you can prove out that math. The best place to figure all of that out is going to mlenow.ca, where you can pull all of this information together fairly simply. It doesn't take very long to do, and you're going to find that not only are you prepared, but you're going to make sure that you're standing in front of the best banks or lenders that can help you for your given situation. I'm going to chat a little bit about a business that we worked with for several years who borrowed expensive money and over time was able to get their way down to cheap money. The reason I'm giving this example today is because oftentimes we see businesses come through mlenow.ca. They either come from their accountant. We have banks that end up sending clients to our platform to get the help because maybe the bank can approve them. And so I thought it was important to talk about this a little bit and give a real life example of how a business was able to get themselves into a better position, because many businesses think that, well, our business is really good at the particular product or service that we offer, but man, we just don't understand this whole financing, money, cash flow. We don't know why we never have money in our bank, and we're not big enough to hire a CFO or a controller. We've got a pretty good bookkeeper, maybe an accountant on staff that's helping us, but I'll walk you through this example, and maybe a few things will become obvious to you, that you do have options. They might cost you a little bit of money, but if you've got a plan, you can work out of them. So this was a company that in the downturn hit a pretty rocky patch. In fact, they're a big company. They have over 100 employees. They're in the manufacturing sector, and they had a line of credit that they were using at the bank to sort of help them float the difference between their payables and their receivables every month, because they would have bills to pay on a regular cycle for materials, for labor, etc. But the money coming in from customers would tend to be 30, 60, 90 days behind. So the bank gave them a pretty significant line of credit to use to help bridge those time periods. And when the economy went south, their business dried up a little bit because the market that they were in was a little bit shaky. People weren't really sure if it was going to continue to exist. And so they couldn't meet the obligations of their line of credit. And so the bank started taking money out of their bank account, and it became a really, really difficult situation. We were introduced to the client because we ended up helping them leverage a building that they were operating out of to free up quite a bit of money to not only pay off the bank that they were working with, but to also give them a little bit of extra to keep floating some of their costs. So we were able to put a private mortgage in place on the building, and that was able to take care of the bank, get rid of the lawsuit, and kind of clean up their house a little bit. And as the market continued to go along, they were able to reconfigure their business. They were able to cut out a lot of the expensive stuff that they didn't really know was as expensive as it first appeared to be. So they were able to adjust, as many businesses were during that time, and they ended up using factoring or accounts receivable financing to collect early on projects or clients that they had done some work for. So that freed up cash flow for them. Now they were paying about 2 to 3% a month for that money, so 24 to 36% a year depending on the month. And that obviously was an expensive option, but it helped them get a little bit further down the field with where they were going with their business. And after they had done enough factoring, and the market had stabilized out a bit, their business had stabilized out a bit, they had another fiscal year under their belt, they were actually able to go to the bank and get a new line of credit for their business that they had years earlier, but through the ebbs and flows of what had happened in the marketplace, they were able to successfully go back and get that line of credit. Not only were they able to get the line of credit, but we were able to refinance out the private mortgage that was on the title of that building and get them a traditional mortgage at very, very low single-digit interest rates. So many times it can seem like a business has no options, but in that, after you get over that moment of panic where you don't have enough money and it looks like the world is falling in on you, the next thing you need to figure out is, okay, is the business and the market stable at all? Is there any element of what we're doing that we can take some measure of confidence in? Or do we simply need more time? Do we need more time to adjust our business to now fit the new environment that we might be a part of? And so that time that your business needs is going to cost you in terms of interest and fees. But if you've got a plan, you can get there. And there's different types of capital that can be used to get you to the goal line of a stable and profitable business. And if you happen to experience a single event or a series of events or some circumstantial things that have happened to affect your business negatively, there is financing and there is a way to fix all of that, but it does take time. But most importantly, it takes a plan. Where there's no plan, the people fail, as the saying goes. And that plan doesn't have to be perfect, but you have to have one. You have to say, sort of, here's where we are today. If we had money, forget the cost for just a moment, but if we had money, here are the things that we could do to get us to a point where our business is now stable and healthy and generating cash flow again. if you find yourself in this position right now, we would encourage you to visit mlenow.ca, where you will be able to see the criteria that has to be met in order for your business to get the financing that it needs. And if you find that, look, I don't really think our business is going to qualify, we've made it really simple for you. When you go on mlenow.ca, you can get a score. It's out of 10. It's really simple. It'll take you less than 5 minutes. But in doing that, you're going to see what's going to need to come together in order to help your business successfully get to the goal that it's trying to reach. We'd love to help you with that. So if you need help, we can help you structure your request and get you the right financing for your situation. But most importantly, don't lose hope. If you think that just because your business has made some mistakes or something catastrophic has happened, or even if it wasn't catastrophic, maybe it was just over time the business was dwindling and no one was really focusing on trying to improve it, but now everything has come to a head and someone needs to sit down and figure this thing out, we certainly would welcome the opportunity to help. So jump on mlenow.ca and make that happen. Today's news and views, I'm going to be covering franchising. There was an article that we here in the office had read about the Men in Kilts franchise, a company that's grown to over $7 million in revenue since they started. The article talked about things like smart money, which is money that has benefits or added value, and they also talked about making sure that you were interacting with someone who has experience funding deals. And so as we read this article and we looked at some of the requests that come in through mlenow.ca, we thought it would be a good topic to talk about, which is franchises, and in particular, the type of financing that's available to franchises. So the most common costs involved in franchising are the franchise fee that you have to pay, so $50, $20, $100, $150,000 just to get access to that franchise. But the other two major costs that we see most of the time, there's actually three, but there's only two that we can help with, which is if there's a physical location, so it's a pizza, it's a donut shop, it's a coffee shop, it's a tire changing shop, there's a physical location and someone, the building is going to need some improvement. So they need some lights, they need some counters, they need some shelves, maybe they need new flooring, paint, windows, etc. That's called TI financing, or tenant improvement financing. And the second type of financing that we see most times with franchises is equipment financing. So you bought a new food franchise, but you need some kitchen equipment, or you've bought into, say, a business like Men in Kilts, but you need a truck or you need some equipment. Then you're going to need equipment financing. So tenant improvement financing and equipment financing are the two types of financing that we see as it relates to franchises. Now, banks and lenders are more than happy to lend to a franchise owner, and clearly the more recognized the franchise brand is, the easier it is to get approved. And as I mentioned, there's that third type of financing. It's not really financing, but the third type of money that you need is sort of that getting off the ground money. So that would be sort of your investment, your cash, your resources that you're using to keep the lights on while revenue is being generated. Oftentimes, someone who's purchasing a franchise might have limited capital and they need franchising to pay for other items. So whether it's tenant improvements or equipment financing or even the getting off the ground money, sometimes they'll even refinance their house or some personal real estate that they have to free up that cash. Before a franchise is purchased, so if you're considering purchasing a franchise and you think you need financing, take heart. There's usually a due diligence process that the franchise will have you go through before they approve the franchise for you. As with any financing that you're looking to get, you're going to want to make sure that you have a plan. How long is it going to take to generate net cash flow? How much will your financing cost you over the term that you're going to have it, like 5 years or 7 years? And if you're purchasing a franchise, make sure you take the time to know your math. Franchises, by definition, are systemized businesses, and that means you should be able to get all of the information that you need to make a smart decision. And so if you need help with franchise financing of any sort, or you just want to talk about it, we'd encourage you to visit mlenow.ca, where you can punch in the business loan amount that you think you need for the franchise, and as you go through the website, you're going to be prompted to answer a few questions, check off some documents that you have, and ultimately you get an Emily score, and you can use that Emily score to see which banks or lenders in the market would approve you based on that score. And so banks love franchises for the most part. There's lots of different options that are available. If you are considering buying a franchise and you think that maybe if you had some financing available to you that you could pull the trigger a little quicker, we certainly welcome the opportunity to help you. And so thank you for joining us on this Emily Now episode. We look forward to seeing you next week again, when we're going to continue to cover some of the topics related to mortgages and loans so that you can do more.